Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Brent Burnett, Head of Infrastructure and Real Assets at Hamilton Lane. Today, we're going to be driving into the infrastructure sector and real asset sector. What's happening? What are they predicting? And what are Hamilton Lane seeing in this space? Brent, if you can share a brief insight into you, please.
Yeah, absolutely. So, Alex, thanks for having me on. I'm the global head of infrastructure and real assets at Hamilton Lane. So I've been here for about 8 years at the firm, and to kind of give you a little bit of sense for how I got into infrastructure, it's an asset class that has really grown in the last, call it 10 years, but you don't really learn much about infrastructure investing coming out of school, right? So I've kind of ended up in this place that I think is fascinating, but it's been a little bit by luck in some ways. I started out of school at a management consultancy called the Monitor Group, and when I started at that management consultancy, we did a lot of work on some heavy industrial companies. So utilities, vertically integrated energy companies. And it was one of these things where I got put with the partner that worked on these types of industries. And I guess I did a good job for it because he kept pulling me in, but I ended up getting a lot of experience with these heavy industrial companies. And we were primarily looking at kind of growth initiatives for those heavy industrial companies. So that was my first exposure to kind of heavy industrial assets. I then left the Monitor Group to join a firm called Flag Capital at the time, which was one of the early kind of marquee fund of funds investors in venture and private equity, and they were launching a real assets fund. So I joined a partner and a principal there. We raised a real asset fund that invested across infrastructure and natural resources. So that was my first foray into infrastructure investing. I left there to join a real estate developer on their industrial side. So again, you kind of start to piece together this experience base that becomes very relevant for infrastructure. And then I joined a manager research function for a large consultancy focused on their infrastructure and real asset manager research function. After that, I left to join a partner who was launching a new firm called Real Asset Portfolio Management. We were going to be a boutique specialist in the real asset space. The founder, my former partner, focused on the real estate side of that business. I focused on the infrastructure side of that business. Together, we grew that for about 5 years. And then about 8 years ago, Hamilton Lane was looking to expand the depth of their expertise in real estate and infrastructure. So they acquired our firm. My former partner, a guy named Steve Gruber, since retired. So we have a separate real estate team now that's led by a couple of other individuals here at the firm. I sit on that investment committee, but my day-to-day continues to be focused on running the infrastructure and real asset business here at Hamilton Lane. So it's been I think a great career of having some good asset level exposure, some good direct hands-on development exposure, and then some advisory and transactional exposure that's kind of led me here.
Okay, appreciate the insight. And private equity doing M&A for its own gain to grow things. Not as common, but it's still absolutely happens. So there's been a sharp rise in interest with regards to the infrastructure in both private wealth and institutional space. What's Hamilton Lane's outlook for kind of 2025 and beyond?
We think that interest is going to continue to grow. We've seen that in our private wealth surveys with allocations increasing to private infrastructure in the asset class. We've seen that on our institutional relationships as well. Now, we don't sort of formulate their asset allocation plans at the institutional level. That's typically done in partnership with a generalist consultant of some kind, but we continue to see allocations increase from kind of 3 to 5 to up to 10% to infrastructure now at the institutional level. And that's consistent with what we're seeing in terms of targets going into the private wealth channels as well. So we continue to expect very strong growth in terms of dollars flowing into this space. And I think the reason for that is, infrastructure is still a reasonably nascent asset class. Private infrastructure is an asset class, but we're finally getting kind of 10 to 15 years in on it where we have very good data to look at. And as we look at that data, what private infrastructure shows is that you get very compelling median returns. You get returns that are comprised of both income and appreciation, but then you have a much tighter dispersion in those returns. So your downside protection's better. And then you get the diversification and the inflation protection benefit. So I think now that not only us, but others have good data to look at the historical returns of this asset class being very compelling, and then there are portfolio construction benefits. That's why you're seeing this increase in target allocations and increase in interest. I think the other piece of it, though, Alex, is if you think about the big macro trends that are driving capital formation, right? You ask any investor, not just an infrastructure investor, but what are the big trends today that people are talking about? It's AI and digitization, right? It's energy transition. It's supply chain optimization. All of these things are fundamentally infrastructure enabled themes. They have to function over a backbone of infrastructure assets. So I think there's kind of the historical data element where you now have visibility into the asset class that's driving that. But then I also think there's a very strong view that for the major macro trends that will drive capital formation, you have to invest in infrastructure to enable those.
So has Drew came on the podcast, obviously also heads up the private equity side of things for Hamilton Lane. He spoke about the effect of interest rates. Has that had a similar kind of mid-level or modest performance from an infrastructure standpoint as well?
It has on certain types of infrastructure. And if you think about infrastructure from a risk profile, and we kind of classify it by core infrastructure up to what we would call opportunistic infrastructure. And core infrastructure tends to be your very long dated assets that are primarily invested in for the coupon payment that those assets generate. So, 90 to 100% of the return profile in a core infrastructure asset can come from the income component. So you can imagine that those are the assets that tend to be priced as a spread over a fixed income alternative. And so in a period of rising rates, that's the asset type that's most sensitive to that because you have an income stream that now is discounted at a higher rate. So in the core infrastructure side, we've seen some modest asset value declines, 5 to 10% in that core infrastructure market that we attribute to rising rates. As we look kind of down the risk spectrum, core plus value add, these are assets that have some element of interest rate exposure, but because only about 30 to 40% of that return's coming from the income stream and the rest is coming from growth, they don't have as much interest rate sensitivity. So now we can only really speak to what we see, but we've seen the kind of growth element of those assets offset on the core plus and value add side, offset the interest rate sensitivity. So we've continued to see good performance driven by operating fundamentals, driven by capital flows into that asset type and the core plus and value add space that has offset some of that interest rate sensitivity. I think, the other kind of interesting thing for us as a secondary buyer in infrastructure is rising rates have actually improved the pricing in the secondary market. 2, 3 years ago, the line of credits that were available for secondary buyers were pretty aggressive. They were priced on variable rates. They had long duration. So there was a kind of trade in the market where you could buy a portfolio of infrastructure interests. You could put that on your line of credit that was kind of ticking at a 3.5%, 4% rate on your line and grow that out over a couple of years until you had to call down your equity capital that was ticking at 8%, right? So that line of credit was accretive to that investment. Well, today those lines are at 7.5%, 8.5%. So they're now approaching your cost of equity. It's not nearly as accretive to use leverage in that secondary market as it once was. So that's instilled a little bit of a return to kind of asset pricing discipline. And that's improved the pricing dynamic in the secondary market. So I think there has been some interest rate sensitivity in those core assets. That's been offset by growth in the core plus and value add. And there are certain subsets of that infrastructure market, like secondaries, where those rising rates have actually, I think, made the market healthier because you don't see the inflated premiums being paid on the secondary positions.
So are you seeing kind of valuations now being more enticing?
Yeah, for certain assets, I think, if and when we tend to think about infrastructure as this kind of homogeneous asset class, right? But it's really not. It's kind of this, a combination of these very different sectors. You got power, which can be traditional power and renewable power. You have transportation. You have data and telecom. You have wastewater, environmental. So there are these different sectors, right? And so when we talk about the valuations, I like to break it down by what we're seeing in each of these sectors because they can be very, very different. The two most, as you can imagine, the two kind of hottest sectors in infrastructure have been data centers and they've been renewable energy platforms over the last 5 years. Um, but that's interjected some risks. If you take kind of data center platforms long term, the multiples for those assets have been in the kind of 16 to 18 times range. It has not been uncommon to see those assets trading in the 25 to 30 times range on a multiple basis in the last 3 years. So that's a sector that, although we believe in the long term growth, we've waded into cautiously and tried to be very selective about the platforms that we've pursued because there's elevated valuation risk in that sector. A lot of capital flow, chasing a lot of development upside that we've been uncomfortable with how some of that value's been attributed. I think the same is true on the renewable side. Long term, that's kind of a 12 to 14 times sector. Those got as high as 18 to 20. In our view, there were some big multiples being paid for platforms that had a lot of early stage development risk in them. And we prefer to attribute more value to the operating assets. So both of those saw valuations run up really aggressively. That's since moderated some. Now you're kind of seeing data centers in that, 18 to 20 times range. So you still have to be careful, but overall, that valuation dynamic has improved. On the renewable side, that's kind of back to 14 to 16 times. Again, you still got to be selective, but that valuation dynamic has gotten better relative to where it was 2 years ago. And then the other sectors like transportation, it's kind of a 10 to 12 times multiple business. It's the transportation assets have largely stayed there. Um, uh, Traditional power is an 8 to 10 times multiple business typically, and those assets up until the last year have been in the kind of 6 times range. So, that's a place where we found some kind of deep value opportunities and good income yields because it was kind of an unloved sector for a while. Same with traditional midstream. So I think overall there were kind of two sectors that got kind of heated. Those have gotten better. And then the other sectors of infrastructure have kind of ticked along where they've always been. Maybe one or two of those has been in kind of a deep value position where you were able to acquire pretty good assets at cheap valuations and high income yields.
Sorry to interrupt. Just a quick mention of our long-standing partnership with Grata. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast. So I'm sure politics plays a part in this. Obviously, there was a lot of transition last year, both us and well, the UK and the US all making changes, which obviously, certainly the appointment of Trump changes a lot of narratives for a lot of different things with the amount of executive orders he has signed. What are you seeing with regards to the regions, sectors of infrastructure that you believe are poised for growth? Obviously internationally and also in the US.
Yeah, I mean, this is a question we wrestle with all the time because, just like you said, it seems to change so fast with the new administration. But I think if you look long term, the two largest growth drivers in infrastructure will continue to be data telecom and renewable generation. And I don't think the policy dynamics changes that. And I'll talk about the reasons why. Right, like the incremental data center capacity, even without AI, is still projected to grow 10 to 12% per annum in most studies. So you've got big growth drivers there absent AI. You then add AI on top of that, and you're talking about growth rates that are projected in the 15 to 20 times range. That equates to somewhere between 15 and 20 gigawatts of installed data center capacity that needs to be met just in the US to meet what those projected demand levels are. And then as kind of a second derivative to that data center, you have the power dynamic. So how do you deliver power to these assets? So that's creating elevated interest in all forms of power generation, traditional power, renewable power. You're seeing more capital deployed into small scale nuclear reactors in an effort to try and power these things. So there's that data center dynamic that's driving demand. That has an implication on the power dynamic. What is the power generation mix that can power that? How do you install capacity quickly to power that? So those are trends that I think continue in both the U.S. and Europe, regardless of policy. Now, those assets are coming into local challenges with their expansion capacity, access to power, interconnection to the grid, access to fresh water for their cooling capacity. They're running into more, I think, local hurdles to getting some of those projects done quickly than they are federal or kind of policy initiative driven hurdles. And those are things that they're going to have to resolve at the local level that could take time. But that's one of the biggest inhibitors to growing quickly with your data center capacity is navigating these local market dynamics where some of these cities and municipalities are saying, geez, why do I want this big data center asset? They don't really employ anybody post construction. They suck a lot of power, so they raise power prices for everybody. They suck up a lot of water in areas now that are short water supply. So there's kind of an environmental and local dynamic that is inhibiting that growth, but that's independent from the federal policy. Um, on the renewable side, and I'll talk the US because that's where I think we've seen the most potential for changes. But if you look at the installed renewable generation capacity in the US, it grew by about 9 to 10% under the first Trump administration, and it grew about 6 to 8% under the Biden administration. So, this is a sector that has been in the process of scaling for a very long time across different administrations. And the biggest risk, I think, to the renewable sector in the US is if you look at, there are two tax credits that can drive some activity, the production tax credit, the investment tax credit for wind and solar. What the Inflation Reduction Act did was codify those tax credits, gave them a little bit more permanency so they didn't have to be renewed as often, and it increased the number of participants that could play in that tax credit market, all of which has been viewed as positive from the infrastructure, private infrastructure, and renewable developers. When Trump came in, I think the expectation was he was going to change some elements of the IRA, which he has. What he's focused on, though, has been the electric vehicle subsidies. That has not been a place that private infrastructure has allocated a lot of dollars. He's focused on U.S. offshore wind permitting. Again, not a place that a lot of private infrastructure dollars have gone. And he's focused on some of the environmental permitting, which should help all forms of power generation. What he has not touched is the investment tax credit and the production tax credit. And the expectation is that he won't. Now, to your point, he's not the most predictable guy sometimes, so you never know. But these are tax credits that have been in place since 2005. They've been renewed by every administration since. I think the likelihood of him changing that in the IRA or pulling a rug out from under those tax credits is pretty low. Even if he did, what we're seeing is that those tax credits typically account for about 100 to 150 basis points of the underwriting return on these projects. So, we're underwriting these projects to a 14 to 16% base case return. Those credits account for 100 to 150 basis points. So it's not nothing, right? That's, 10-ish% of your return, but it's not the driver of the economics of the project. It's a nice add-on, but you can still do these projects economically with the right off-takers absent that credit dynamic. So That's a long-winded answer to say I think the risk is low, but even if they were to make drastic changes, I think you still have strong project level economics that can drive those. Also, in the US, you have 30 some states that still have renewable energy standards. So, absent a federal policy overlay, you're going to continue to add installed generation capacity and renewables just to meet the state demands.
How do you see some of these trends, kind of within infrastructure investing in the coming years affecting kind of the impact with regards to fundraising?
Yeah, I think so there's been a couple things happening in the fundraising market and infrastructure. Institutions in particular really scaled up their exposure in 2021 and 2022. And then across all private markets, infrastructure was no different. In 2023 and 2024, you had historically low levels of distributions across assets, right? You were not Interest rates did have an impact on total transaction activity. You weren't seeing assets monetized as quickly. So, on average, infrastructure's returned about 20% of NAV per year on a distribution basis. And in 2023 and 2024, that fell to like 10%, 8 to 10%. So, almost half the long-term averages in those 2 years. So in a market that relies on this recycling of capital to recapitalize new funds and new relationships, 2023 and 2024 were very difficult fundraising years because of that. There was not nearly as much capital being invested because of the overhang from 21 and 22. Institutions weren't getting it back as fast as they needed it to. So those were pretty challenging fundraising years. Um, what we're seeing in 2025 is that starting to break free. We're seeing assets being teed up for sale in the first half of this year. We're seeing allocations come back to the market that are being freed up for more infrastructure investment. So we expect 2025 to be a better fundraising year than 23 and 24 because of that realization activity that we expect to improve. But the last 2 years have been pretty tough. I think um, anytime you're in a tough fundraising market, you're probably in a good or relatively good investment market. And I think that has been true. I mentioned you've seen some of the valuation peaks come off in some of the best assets in the sector. So it's been a good place to find some value in 23 and 24. For us as a co-investor and a secondary investor, there's been more volume in the secondary market because lower distributions from portfolios result in more portfolio rebalancing. And so there's more volume in the LP secondary market for infrastructure. That's helped pricing in that market. As a large co-investor, when GPs are having a harder time raising capital, that means they're coming out to partners earlier and more often for a co-investment dollars to capitalize deals. So it's been, kind of a great market for certain elements of investing, but a challenging fundraising market over the last couple of years.
I think there's a lot of people listening that are going to be very pleased that you're giving the indication that things are going to be getting better. So no,
Exactly. Yeah.
no
I'm gonna
pressure,
get some
Brent.
calls. If it's not, I'm gonna get some calls saying, "Hey, you said it was gonna be easier this year."
Yeah, absolutely. So if not, blame Brent. So I think that's a simple message we can put out here. Not only am I the host of the Private Equity Podcast, I'm also the founder and managing partner of Raw Selection. Raw Selection's an executive search firm working exclusively within the private equity industry, supporting the portfolio companies and the private equity firms with securing exceptional talent with our motto of de-risking executive search. Obviously had a difficult fundraising period, but I saw that Hamilton Lane launched two evergreen funds aimed at expanding the access to private market infrastructure investments. Looking beyond the kind of asset class rapid growth and compelling risk adjusted returns, what are the benefits for investors in terms of adding this asset class to their portfolio?
Yeah, I think the investment benefits as we talked about are pretty clear. You get good income yield, you get good total return. And this is talking, I mean, I would love to tell you this is true about our funds, but this is talking broadly about the asset class, right?
Of course.
I think the investment arguments for it are very strong in that, you get good total returns, but you get some element of income and capital appreciation. There's a diversification benefit, and then there's the inflation benefit. And it's hard to find an asset that can deliver all four of those things with very strong downside protection. So I think that is what's driving the interest. And I mentioned before, I think private wealth investors are not unlike institutions in that they think about these big themes and where the opportunities are going to be. And I think they increasingly view infrastructure as a little bit safer way to play those big themes, right? Through the asset ownership. By owning the assets that these technologies and services will rely on, you can strip out some of the business model risk or some of the technology risk that you may have to take on further down the kind of value stream. And so I think asset ownership is a way, infrastructure asset ownership is a way for these individuals to play these big themes. Um, I think the other just evolution we've seen in the market, because the biggest sort of detriment to private markets has always been, well, they're illiquid, right? And they are. They are illiquid. And our funds are not indifferent than others in that we don't sort of, advertise these as a trading vehicle by any means, but there is an element of liquidity. So if we can offer access to a private market asset class like infrastructure that has very strong investment level fundamentals, strong support for long-term macro themes, and we can do that in a vehicle that provides some element of liquidity for these private wealth investors who may need it. That solution has been evolved now that I think it's becoming much more attractive. So I think in addition to the evolution of the asset class, there's been some evolution in the product design in this space that has made it more appealing. And I'm not talking about our products necessarily, but the product design and what's available to those private wealth investors in this space has evolved to something now where they find it very appealing.
So, what are your influences? What do you read? What do you watch? What do you listen to, Brent? Do you recommend that others listening to the podcast check out?
Oh, yeah. It's I mean, there's kind of like the business side, right? Where you kind of listen to podcasts because they're relevant to your business. So, the private equity podcast, I do listen to that. I like In Good Company. I think there's been some good episodes with some private equity senior people there that I found interesting. There's another one that Bain does called Dry Powder, and so they'll occasionally have some themes on there that I think are interesting. They did one recently on automation that I thought was pretty interesting. So there's kind of that business side that, you listen to these things because you want to know what's going on in your industry. Uh, just on a personal level, I like Hidden Brain is one that I really like. I don't know if you've ever spent any time with that, but it really kind of it uses examples to go through how our brain works, which I find fascinating. And I do think there's a lot of investment relevance to it because you need to be aware of the biases you hold, the emotional responses that you have to things. And Hidden Brain is one that I think kind of helps you think about those things. There's another one I like called American Scandal, and it kind of goes through all of the big scandals in American history and really tells the story of what was going on. And again, it's that to me, there's an investment application to it in the sense that a lot of these scandals revolve around misplaced trust, right? And so as we're evaluating partners to invest with, deals to invest in, there's a certain degree of trust. As good as your diligence process is, and as good of a history as you have in not making mistakes, there's always a certain element of trust in that, right? And so I find American Scandal interesting because it focuses so much on situations of misplaced trust and how do we be aware of our willingness and sometimes our need to trust somebody. On the book side, there's a couple of books that I find that I'm reading right now. I think like most people, and I'm sorry, I'm freezing up here, Alex. Am I good on your side?
You are okay, my side, yeah?
Okay, yeah, sorry, I froze up on my screen here.
No problem.
I guess like most people, I'm like in the constant search of why I have so many bad habits. What's like the secret sauce to fixing them? So I'm always reading these books about how the brain works in habit formation. So right now I'm reading a book called Atomic Habits. And it's pretty interesting to again kind of helps you understand why you develop certain behaviors. I feel like I've been in like the research mode on habit improvement for like 10 years, and at some point I'll get to like the implementation of actually changing things. But this is another great like research book. Um, I'm reading a book called The Comfort Crisis, which I think is really interesting. It kind of talks about how the comforts that we enjoy in life sometimes make us unhappy, and by getting ourselves more uncomfortable physically, financially, emotionally, that can elicit certain changes in us that are good. So that one's been interesting. Um, so those are a few of the books that I'm reading. I'm reading, and then like on just pure kind of entertainment value for me, because I think it's interesting, is I'm reading a book on the Comanche Empire. I think it's called Empire of the Summer Moon. But it's really fascinating about the kind of uh, evolution of that society and its eventual decline here in the U.S. So that's kind of the mix of things I'm reading. Some I think make me better at my job. Others are just for entertainment.
Appreciate that list. That was fairly comprehensive and a few new ones for me to make a note on. Um, if anybody wishes to reach out to you, Brent, post this podcast, how best do they do so, please?
LinkedIn, yeah, LinkedIn's probably the best spot to get me. And if they hit me up on LinkedIn, I can share my email contact info there.
Perfect. Well, thank you very much for joining us, Brent, giving you time. We don't usually get the big boys onto the, as we call them in our world, onto the private equity podcast. So thanks for Hamilton Lane for letting you on and sharing your insight into the infrastructure space. We will be holding you accountable to the amount of deal flow for this year. So if not, reach out to Brent and we can get him on LinkedIn and tell him for ruining our hopes. But jokes aside, thank you very much for coming on and sharing everything that you have done.
Absolutely, Alex. Thanks for having me. And if you get any follow-up questions from it, let me know. Happy to answer things over email if they come up.
Absolutely. That's very kind. So thank you very much for that. And thank you very much for everybody for yet again tuning in to the Private Equity Podcast. Till the next time, keep smashing it. And thank you very much for listening.